Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who've subscribed to the channel. I really do appreciate it. The channel continues to grow because of people like you. Now in this video, we are going to take a look at 3 stocks to potentially buy at or near their 52-week lows. This could be a huge opportunity that you might not want to miss, and they may be in your portfolio that you want to continue to add to. But before we get into the video, if you could do me a favor, take a moment to hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever we put out any new content. I do other video series. I do a portfolio update every Sunday morning. It's free to see what I'm doing in my portfolio. Nothing to pay for, no paid Patreon, no other sites that I send you to. I'm not selling you any courses, bro, none of that stuff. But doing all this really does help out the YouTube channel with the YouTube algorithm. So again, thumbs up button down below. Make sure you hit that subscribe button. Make sure you're subscribed. Hit the notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you think of these 3 stocks. Are there other stocks near 52-week lows that you like better? Are there other stocks that you're currently adding to your portfolio? Or maybe you're looking to sell these ones since they are not performing. I'd love to hear from you in the comment section down below, and share with anyone you think that might find value. Again, doing all that really does help a small YouTube channel like mine grow, and it helps spread the videos with the YouTube algorithm. Let's jump back into the video. We're going to take a look at the 3 stocks that are at or near 52 weeks low that should maybe be on your potential buy list for the next week or two. So first up on our list is definitely a household name here, Johnson & Johnson, ticker J&J, out of the healthcare sector. And overall, really, the healthcare sector has pulled back, not just Johnson & Johnson. I know Bristol-Myers Squibb out there, CVS, several others have really pulled back. So it might be time to look at the overall sector and see if you can find some value. But for this particular video, we're going to take a look at Johnson & Johnson. Closed out the trading week last Friday. It is Memorial Day. Happy Memorial Day to everyone out there. So this will all be, everything that we're going to look at is based on last Friday's numbers here. Closed out the week at $146.97. 52-week range as low as $143.13, as high as $175.97. So again, right up against, just off of its 52-week low. You can see here earnings per share is sitting at $15.09 per share. Very nice. Price to earnings is currently $9.74, though the forward PE is a little higher than that at $13.62. Dividend yield is 3.38, and the dividend annually is $4.96. Divide by 4 because it is a quarterly payer, though on the next slide we'll see their yearly payout. You can see here their beta of 0.55, so they are less volatile than the overall market. Analysts call it a consensus buy. They have a price target of $166.21, which would be a potential 13.09% upside, at least according to the analysts that have taken a look at this. Earnings date was July 18th. Looks like their ex-dividend date was May 20th. They are going to pay out on June 4th. So you wouldn't be in line for that June 4th payout if you were to buy them now. You'd have to wait till the next quarter. So you'd have to wait 3 months for the next payout, right? Now, we're going to jump over and look at dividend yield theory here. Look at that. You take a look at the 5-year dividend yield average of 2.68%. You compare it to its current 3.37%. And since its current dividend yield is higher than its 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now, their payout ratio is 70.73%. I like 75% or lower because that gives them a 25% little margin of safety. If they were to have a bad quarter or two, they have the extra cash to continue to pay out the dividend, pay down debt, pay back into the company to do acquisitions or revamp the company overall. So it's getting up there, but it is not out of line with where it would be for my potential investing, right? Again, I like 75% or lower. Now, some of you, if you have a lower payout ratio, 60, 65, 50%, whatever it is, maybe this one isn't one, but for me, I like 75% or lower. Now, return on equity and return on invested capital speak to how well the company is reinvesting its capital back into itself. I like 10% or better for these metrics. Return on equity sitting at 54%, smoking high, very good number here. Return on invested capital sitting at 18.54%, very good. Overall, I really like how efficiently Johnson & Johnson reinvests back into itself. Now, as a dividend growth investor, I want growing dividends over time, and typically to have that, you need to have a company with growing free cash flow. So we're going to look at their free cash flow and the repurchase of capital stock because I want the company buying back shares, not diluting us as a shareholder. So We're going back to 2020 here. You can see 20.1 billion in free cash flow. 2021, 19.7. Looks like a little bit of a drop there. 2022, another drop down to 17.1. 2023 up a little bit to 17.7. Though, if I look at the repurchase of capital stock, you can see 3.2 billion shares, 3.4, 6 billion, 5 billion in so they are repurchasing shares, and some of these drops, as you can see here, from 20.1 to 19.7, but also they went from 3.2 billion to 3.4 billion. So that's pretty close to flat free cash flow. I'd have to do the math to see maybe even slightly growth there. We'll call it flat, and then they double their repurchase almost here from 3.4 billion to over 6 billion here. So this 17.1 from 19.7 to 17.1, that definitely is accounted for in the repurchase of capital shares. And a little bit of a drop here, but they had increase in free cash flow, though they decreased their repurchase of capital shares. You could call that an increase as well. So overall, I'm actually seeing an increase in free cash flow, or at a minimum flat free cash flow, with the addition, looking at these repurchase of capital shares, because they have increased it significantly from what they were doing back in 2020. And I would like to see them continue to repurchase those shares, especially right now, for what it seems to be is a bargain. Maybe not as big a bargain as there are out there in the market, but certainly saving estimated 13% on Johnson & Johnson, which again is a household name. It's been around for decades and decades. Your grandparents were well aware of this company, as well as your parents, as well as you and your kids as well. So let's keep going here. We're going to take a look at Johnson & Johnson's revenue. We want growing revenue over time. You can see here it actually decreased in 2021, was flat to 2022. From 2022 to 2023, it has increased. Hopefully that increase continues on into 2024. We'll have to wait for those numbers to start getting released. But so far from 2022 and even back from where it was in 2020 and 2019, growing revenue. Profit margin here, a little bit of ups and downs. You can see 2019, a bit of a drop there, big jump up in 2021, a drop down in 2022, but then again, nice increase from 2022 to 2023, and increase from 2021 overall. Going back to 2019, you can see that kind of increase there, even though it is a little bit of up and downs. Currently sitting at 41.28%. That's a very nice profit margin sitting there. Revenue was at 85.16 billion. We're going to jump down to J&J's EBITDA. Right, that's earnings before interest and tax deductions and amortization. So this is basically the money that's left over after they remove everything. Right, so you see revenue is at 85 billion. Then you remove all of the everything else, right? Interest, tax deductions, and amortizations, and you're left with the 45.15 billion. And same thing, you can see here, 2019 looks like a little bit of a drop, then 2021, then 2022. A little bit of a drop there, then a big jump up in 2023. Overall, from 2019 to 2023, nice growth there in EBITDA. And then to round out Johnson & Johnson, 3.38% dividend yield, nice starting dividend yield, annual dividend $4.96. We already saw that, ex-dividend date, we saw that. It is a quarterly payer. They have a payout ratio, they say 32.87. This is actually not correct. I would say it's closer to that 70% that we saw from Yahoo Finance. This is brought to you from stockanalysis.com. This is why I look at more than one site, because sometimes the information is not the same, and you want to be able to make sure you can back check some of this. So I would say it's probably closer to that 70%. They're saying 32.87%. Even if you wanted to add the two and divide, that would put them, around the 50% range. It's below the 75% I'm looking for, which is really all I'm concerned with. Dividend growth, 5.02%. Nice dividend growth here. Have been growing the dividend for 62 years. So again, this is why they're a household name. Not only the products that they provide, but for investors, they have been steadily growing the dividend for 60 plus years. And that's what us dividend growth investors look for. Buyback yield, very positive, 6.73%. Very good. Shareholder yield, 10.11%. Overall, great numbers. It is paying a $1.24 per share. And again, it's going to pay out on June 4th. Overall, Johnson & Johnson is the biggest position in my portfolio currently. I'm not looking to add a lot, but I would like to continue to nibble as long as it stays down in the 140s to mid to low 150s. I would look to add. I think I have 112 shares here. I might try to run it to 120 or something like that. Not looking to add a lot, but I wouldn't mind adding 4 to 8 shares over the next month here as we enter June. The next one on the list is out of the consumer discretionary sector. This, much like Johnson & Johnson sector, the healthcare sector, I'm seeing a lot of value in the consumer discretionary sector. McDonald's is really, and a lot of the fast food companies have really pulled back. So that's consumer discretionary. Starbucks has really pulled back. Several other, Nike has really pulled back. So there are a lot of companies in the consumer discretionary sector that have pulled back. And that really tends to speak to we are either in recession or are entering recession, or at a very minimum, we're entering an area in the market where people are starting to pull back on that discretionary spending. You know, they're not going to pay for furniture, which is what Haverty Furnitures provides. They're not going to pay for those extra coffees or teas, you know, at Starbucks. They're going to back off of that extra set of Nikes or new pair of shorts or workout clothes and just keep what they've got, right? So when you hit hard times or people start pulling back or, you know, starting to feel the effects of higher than normal inflation for longer, these are the type of companies that get hit, but it also potentially provides buying opportunities whenever they do get hit, because when the economy bounces back, these are the companies that typically bounce back with it. Right, so they closed out the day on Friday at $27.63. 52-week range as low as $25.07, as high as $37.05. So again, another one that's just right up off its 52-week low there. A beta of 1.46, EPS at $2.76 per share. PE ratio low at 10.01. Forward PE sitting at 11.79, so a little bit higher forward PE than the current. Dividend is $1.28 per share. We'll see the monthly payout here or per share payout here. It is a quarterly payer. Nice starting dividend yield on this one, 4.63%. Ex-dividend date is May 23rd. It looks like they're going to pay out on June 14th. So another one, you wouldn't be in line for the dividend, that June dividend payout, but you would be for the next one if you were to buy them now. Analysts call it a strong buy, or I'm sorry, beta we didn't cover, beta of 1.46. So they are more volatile than the overall market. Unlike Johnson & Johnson, where we saw less volatility, this one is more volatile. And you can see that volatility throughout the day here, right? That's a one-day chart, and that is a lot of ups and downs, a big range from 26.73 down to right about 27.40, right? 20 cents range there on the day. Analysts call it a strong buy. Price target of $45, which would be a potential 62.87%. Now, you'd want to go to stockanalysis.com, where I pulled this from, and you want to go into each one of these tabs and really review. And this one would come out of the forecast tab, and you want to see how many. If I remember correctly, I think there's only maybe 1 or 2 or 3 people that are reviewing this. So take this with a grain of salt. Whenever there's that few analysts looking at a company, you've really got to do your own deep dive. It doesn't give you much to lean on if there's only a couple people looking at it. And Haverty's is one of those small cap companies where it doesn't have a lot of eyes. So take that one with a grain of salt. Earnings date May 1st, so tune back in for that if you're interested. Again, we're going to take a look at dividend yield theory here. To do that, we look at their 5-year dividend yield average of 3.6%. Compare it to forward annual dividend yield, or where is it right there? Forward current dividend 4.63. They're the same number. Since it is higher, that speaks to undervaluation again. And all of these businesses, according to the dividend yield theory, are potentially undervalued. That's why we're looking at them. Payout ratio is low, 43.48%. So that is very good. Again, I like 75% or under. So that gives Haverty plenty of room. Even if we are entering some slower times, they have a lot of room there to absorb any downturn that they have in free cash flow, continue to pay out that dividend, continue to reinvest back into the company, continue to make acquisitions or buy back shares and pay dividends. That's what we do with free cash flow. So plenty of room there. Low payout ratio, very good to see on this one. Now, we're going to look at return on equity and return on invested capital, again, to see how well the company is reinvesting back in itself. And on them, they are a little lower than Johnson & Johnson. Return on equity sitting at 15%, so that meets the 10% margin that I'm looking for. Our return on invested capital is a little bit lower at 8.04%, but it's not so far off that I would, throw them in the trash bin. It just wouldn't meet the 10% I'm looking for. I'd like them to improve on this. Hopefully they do over time. We're going to look at free cash flow again, right? We want growing free cash flow because we want them to be able to pay out the dividend and continue to pay the dividend and raise it over time. So 2020 here, we see $119 million in free cash flow. 2021 actually looks like a bit of a drop down to $63 million. 2022 looks like a bigger drop down to $22 million, and a jump back up in 2023 up to $44 million. And you can see here again, repurchase of capital stock going from $19 million to $41, $29, $6 million, Overall, this does not account for it. It does actually look like they've got some decreasing free cash flow. Not necessarily in 2021. I'd have to look and see. They went and increased their repurchase of capital shares by about 4 times what they normally do. So that looks like it might account for the drop in free cash flow there with the repurchase of shares. It does not account for it in 2022. Not only did free cash flow go down, but they also dropped their repurchase of shares from 41 million to down to 29 million. And then it definitely does not account for it in 2023 either. From 22 million to 44 million increase in free cash flow, but they dropped down the repurchase of capital shares. So again, you'd have to do the overall math there. Overall, I would say it's actually decreasing free cash flow from 2020 to 2023, and depending on how they look in 2024, that might give them a second year with decreasing free cash flow. So it would be one to watch in that area. And then again, if we were in a prolonged recession, might give them some trouble. But that's why you look at this, right? That's why you look at the payout ratio here. You want a lower payout ratio with companies like this, so you can make sure if they do hit rough times, they can still continue to pay that and then ride out those rough times, right? Now let's look at the other metrics here. We're going to look at revenue again. You can go back to 2019, a bit of a cyclical company. Dropped from 2019 to 2020. Then it looks like jumped up to 2021, jump up again in 2022. So far, 2022 to 2023, it dropped down. We'll have to see what 2024 numbers do. I'm almost going to project another decrease here, probably back closer to where we were back in 2020. And hopefully in 2025, they rebound. So revenue on these companies, and consumer discretionary typically is cyclical. So this is not necessarily bad. I mean, it is up from 2019. It's just down from the 21 and 22 years here whenever they had pretty higher than normal. You had a lot of people staying home here, right? So you might have had a lot of people buying furniture that typically don't buy furniture every year. Something you buy maybe every 5 or 10 years. So cyclical company, but whenever it's down, these are the times you want to be buying these cyclical companies. So whenever it does rebound, then you can catch that rebound. Profit margin here, same thing. 2019, growth in 20, growth in 2021, but from 2021 actually to 2022, and then again in 2023, decreasing the last 3 years, though it is up significantly from where it was in 2019 at 6.53%. Revenue was at 862.13 million here, if I didn't mention that. And we're going to look at their EBITDA again. Pretty similar, right, to what you're seeing in profit margin, and it should follow the profit margin pretty well, because all you're doing is taking those numbers and reducing, the interest, EBITDA, earnings before interest, tax, deductions, and amortization, right? So once you remove those, you're down left with the bare numbers. 2019 growth in 2020, growth in 2021, little bit of growth in 2022, but a big drop from 2022 down to 2023, 91.31 million. It is up from 2019 numbers. Looks like it's about flat, maybe slightly down from where it was in 2020. But again, cyclical company, so we might be entering in that downturn. 2024, we'll have to wait and see what the numbers look like. Nice starting dividend yield, 4.63%. Annual dividend, $1.28. Ex-dividend date, May 23rd. We saw that. They are quarterly payer. Payout ratio low, 46.38%. Nice dividend growth on this one, 8.13%. Only 3 years of dividend growth, so hopefully they maintain that. Buyback yield of 0.2%. It's in the positive. That's good. Shareholder yield 4.65%. Again, in the positive. That's good. Dividend is 32 cents per share. Now, this is an interesting one. I want to talk about this for just a second. They do pay a quarterly dividend, but typically around November, they pay a special dividend, which is higher than their quarterly dividend, or at least that's what they've done for the last several years. So I'm assuming they're going to continue to do that. So 3 months out of the year, you're going to get this, 32 cents until they raise it. And then that November payout will be the special dividend, which the last several have been right around $1 per share. So it might not be exactly 32 cents every quarter. You might look out for that special dividend later in the year. Lastly, we're going to take a look at Whirlpool Corporation, ticker WHR, out of the industrial space. I'd like to call it out of the consumer discretionary sector, because it is a consumer discretionary. Your refrigerators, your washers, your dryers, that sort of thing is a discretionary item, but I believe they actually fall under the industrial sector because they manufacture these. Correct me if I'm wrong down in the comment section, but I believe it's out of the industrial sector, though their products are discretionary, right? So they closed out the week at $86.52. You can see here 52-week range as low as $85.82, as high as $160.62. So right up against its 52-week low, off it a little bit, but still right there close to its 52-week low. EPS sitting at $7.26 per share. PE sitting at $11.92. Now this one is a little flip-flop. Its current PE is actually a little higher than its forward projected PE at $6.41. Dividend is $7. They are quarterly payers, so divide by 4, though we'll see it on the next slide just like we did on the other ones. High dividend yield on this one, 8.09%. But is the dividend safe? That is going to be, again, this one is my least favorite out of the 3. This is not one in my portfolio. Haverty and Johnson & Johnson, both in my portfolio. Full disclosure, I am long Johnson & Johnson, and I do hold a position in Haverty. This one I do not, and this one, based on the numbers, once we run through them, you'll probably agree, is not one I'm looking to get into. This one looks like it's down because it's having some troubles. Not that Haverty is down because it's not having some potential troubles right now, but it's more of a cyclical company. Whirlpool also is a cyclical company, but this one is, again, we'll run through the numbers. You'll get the point why I threw this in here. And I threw this in here so you could see a comparison between some that I potentially am investing in and some that I am not investing in, and what the numbers look like and potential reasons for why I would invest or why I wouldn't. A beta of 1.52, so they are more volatile than the overall market. Analysts call this a hold, and I would definitely agree with the analysts on this. They have a price target of $120, which would be a potential 38.7% upside, which looks very nice if it was to run back up to that 120. Earnings date July 22nd. Ex-dividend date was May 16th. Pays out June 15th, so another one. You wouldn't be in line for the June payout. You'd have to wait till the next quarter, so 3 months for the next one. If you were buying them now, you wouldn't get that payout. Now, we're going to take a look at dividend yield here on this one, just like we did on the others. 5-year dividend yield average, 3.88%. Forward dividend, 8.09%. Since it is higher and much higher, it is speaking to undervaluation on this one, but is it undervalued for a good reason, right? That's the kicker here. Now we're going to start getting into some of the numbers that I don't like. Payout ratio, 96.29%. Not good. Higher than what I'm looking for. Also screams dividend may be in jeopardy of being cut. So very high dividend yield, but do they need to cut it in half to get it back down here closer to their 5-year dividend yield average and bring down this payout ratio while they're having some troubles, right? That's where I start getting into some worries. When a company is having trouble and they have such a high payout ratio, their potential dividend cuts. Unlike Haverty, which we saw on the previous one, where their payout ratio is in the 40s, they are almost up against their max. So almost all of their free cash flow is going to cover the dividend. That does not give them much left to pay down debt, repurchase shares, unless they're taking on additional debt or unless they're issuing shares out there to shareholders. Their payout ratio being this high should scream scary. Watch out, potential dividend cut. That's what it should be saying to you when you see this, plus whenever you mix it with all the rest of the numbers we're going to see here. Now, looking at return on equity and return on invested capital for this one, again, I like 10% or better for both metrics. Return on equity meets it at 18.2, return on invested capital at 6.54. So again, unlike Haverty, which we saw on the previous slides, they were at 8.09, I believe, on return on invested capital, so pretty close to that 10%. This one is not 6.54%. It is, almost half of what I'm looking for. So that gets a little concerning for me. I'd like to bring this up significantly. We're going to take a look at free cash flow going back to 2020 here. You can see 2020, $1 billion in free cash flow. 2021, nice jump up in free cash flow to $1.6 billion. Actually, to be honest, I was buying them back here in 2020, 2021. The numbers looked a lot better. They were still maybe having potential troubles, but they didn't look as bad as they do now. As you can see here, going to 2022, big drop, $820 million in free cash flow, and even further drop in 2023, $366 million. They were repurchasing shares in 2020, 2021, and 2022, but they did not in 2023, and they shouldn't. They are having troubles. They should stop that. Again, 96% payout ratio, you can't repurchase shares. That's what that does. That elevated payout ratio starts to eliminate the repurchase. First, you get rid of the repurchase of shares. Then you have to cut the dividend, or you have to do some other things like take on additional debt or issue more shares to help offset this. And the repurchase of shares,
does not account, in my opinion, in 2022 for the drop from 1.6 to 820 because they also decreased their repurchase of capital shares from 1 billion to 903 million. So this one is looking a little rough so far. Let's continue and finish it out. Revenue 2019 here, you can see it dropped in 2020, jump up in 2021, and it's been dropping since 2021. Drop in 2022, slight drop in 2023. It's currently at 19.46 billion. Profit margin here dropped from 2019 to 2020, big jump up in 2021, huge drop, negative profit margin in 2022. They're back positive in 2023, but barely 2.47. So again, even though it's a cyclical company like Haverty, the numbers do not look as good, right? 2019 EBITDA looks like down a little bit in 2020. Should follow profit margin pretty closely, right? You can look at the graph here and see that it closely matches. Jump up in 2021, big drop whenever it was negative in 2022, jump back up to 2023, currently sitting at 1.27 billion. And dividend yield again high, but is it safe? Payout annual dividend $7, divide by 4, it's $1.75 per share. Quarterly payer, 96.42% payout ratio, no dividend growth currently, and they shouldn't be. It's actually probably on the cut the dividend, like a lot of companies have been doing whenever they get high in this payout ratio, they cut the dividend. That's what it should be screaming to you. If you see anything up here in the 90 plus dividend yield payout ratio, you should be concerned. Buyback yield is negative. That's not good. That means they shouldn't be buying back shares. Shareholder yield is 7.91. That's at least you're getting a positive shareholder yield as a shareholder. May 16th dividend, $1.75 per share. June 15th payout ratio. Again, hopefully you were able to see the difference between Johnson & Johnson and Whirlpool and see why Whirlpool having trouble is a negative and you should stay away until they start to fix some things. Whereas Haverty and Johnson & Johnson might be buying opportunities because the numbers look pretty good, but it looks like they may be having some temporary troubles that aren't underlying issues. Again, profit margins down this low, 2.47%. That's ridiculously low for a company like Whirlpool, and it doesn't give them any room for error. They could easily be 2024 negative numbers again. So Whirlpool is not one I'm looking to add, whereas Haverty and Johnson & Johnson are two that I am looking to continue to nibble on in my portfolio. Let me know what you're looking to buy here. What are the stocks near 52-week lows that you are keeping an eye on? I know there's more than these three, but these are the three I wanted to cover. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have companies you'd like me to cover in a future Stock Pick of the Day series, which I do Monday through Thursday, not this Monday, the market's open, but typically Monday through Thursday when the market's open, drop it in the comment section down below. Don't forget to turn on that notification bell so you're notified whenever we put out any new content. Go check out my recent portfolio update that I put out last Sunday, which was yesterday, to see how my portfolio is doing. Let me know what stocks we have that you have that I have in my portfolio. Would love to hear from you. Happy holidays. Happy Memorial Day. Hope you're having a great weekend. And as always, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice unless you're in my opinion in investing, educational, and entertainment purposes. Investing involves risk and kindred money to never invest any amount. It comes losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel certified financial advisor.